The Starwood Property Trust price just dropped more than 10% in 2 weeks, so I bought some more. Why? Because there are 2 Starwoods and only one of them has issues. Starwood Real Estate Income Trust has been all over the commercial real estate news because it restricted withdrawals. Investors don't like that, but there's nothing they can do about it because it's a private REIT. On the other hand, Starwood Property Trust is a publicly traded REIT, ticker STWD, and investors can buy or sell STWD at a moment's notice. Does all that sound confusing? Well, the market is confused and a little bit fearful, and I think that spells the opportunity. Let's look at what went wrong, why the price of STWD fell, and why this might be a buying opportunity. We're talking about 2 completely different entities, so to keep things simple, I'll refer to them by their abbreviated names. SREIT, SREIT, is the one that's been in the news. It's not listed on the stock market and it's not available to everybody, which is probably why you've never heard of it. The minimum investment is $5,000 and you have to meet asset and income thresholds to qualify to buy it through a financial advisor. So how does SREIT make money? Well, they pool investor funds to buy real estate. Here's the breakdown. Apartments are the largest category. Why would investors give their money to SREIT? Well, 8% average annual return since inception, that's not bad, and it doesn't correlate directly with the stock market. Also, it's quite tax efficient because it distributes return of capital, which means no tax due until the investor sells. Of course, real estate isn't really a liquid asset, so to ensure that they don't have to sell buildings in a rush, SREIT has typically limited investor redemptions to 2% of the value of the portfolio per month. Investors knew that if there was a rush to withdraw, they may have to wait. The fund kept some cash on hand to accommodate requests for redemptions. The big news that sparked the media stories is that SREIT recently changed that maximum redemption from 2% per month to 0.33% per month. Why? Because high interest rates have depressed commercial real estate prices and now is a terrible time to sell. The expectation is that interest rates will begin to fall within, say, 12 months, and at that time, prices will begin to rise again. Obviously, some investors don't like that news, but it's just the nature of a REIT that's not publicly traded. Also, worth noting that SREIT investors will continue to receive their normal distributions. If you're wondering if this has happened before, the answer is yes. The largest private REIT is operated by Blackstone, and they went through the same thing in 2022. They said it would be temporary, and it was. In February of 2024, the redemption restrictions were removed. As a result, the demand for redemptions fell back down to normal levels, and it's business as usual. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and this one fits right into the middle of that strike zone. STWD is a very different investment from SREIT, as we'll see shortly. So why did the STWD price fall? Well, fear and confusion. Here's what they actually have in common. The word Starwood, Barry Stoneley as a senior executive, and the words real estate, and that's about it. STWD owns a small amount of real estate, but their primary business isn't being a landlord, it's lending. STWD is classified as a mortgage REIT or MREIT. So to summarize, SREIT is a landlord, STWD is a lender. The other key difference is that SREIT is not publicly traded and STWD is. You can buy or sell STWD on the New York Stock Exchange. I reviewed STWD back in July of 2023 and concluded it was worth buying. If you want to learn how STWD makes money, you can watch that video, but here's the 15-second version. This is the breakdown of STWD's assets. Only 12% is actually real estate. The rest of the assets are income-producing loans, and those loans are spread across infrastructure, residential, and the largest group is commercial lending, which you could further break down into multifamily, hotel, etc. Here's the dividend history for STWD. No growth recently, but at a 10% yield, there's room to spend some of it, reinvest some of it, and create your own income growth. There have been no dividend cuts, not even during the 2020 pandemic, which is a positive sign. However, the pandemic did hit the price really hard, much harder than the market. So that's something to consider. The price went on to recover fairly quickly after the pandemic, but then rising interest rates dealt it a second blow. So the 10% yield is great, but sometimes it's a pretty wild ride in terms of price. Speaking of dividends, let's look at dividend coverage. Let's see if they can actually afford to pay these distributions. There are two things to look at. One, are there enough earnings to pay for the dividend? And secondly, what's the trend for distributable earnings? This table shows the amount of earnings available for distribution after deducting all the expenses of the business. We can see that there's 59 cents available, and of that 59 cents, they only distributed 48 cents. There was more than enough to cover the distribution. Secondly, we can see that the extra cash they have left over after paying out the dividends has actually increased recently from 1 cent per share to 11 cents per share. These are all good signs. By the way, this table came from some analysis on Seeking Alpha that covers this topic in more detail than I can in a video. When I say this topic, I don't mean STWD generally. There's over 100 articles about that topic. I mean specifically addressing how SREIT's liquidity crunch creates a buying opportunity for STWD. I don't buy any stocks or funds without first checking Seeking Alpha. I'll put a link to that article in the description and a link for a free trial and a discount for premium membership, which is the level that I use. STWD has one other advantage that's not so obvious, and that's access to cash and credit. If they see opportunities in the market to buy distressed commercial real estate, or more likely distressed commercial real estate loans, they have access to almost $10 billion to scoop up some deals. There are a couple of ways to look at pricing for STWD. Firstly, the price-to-book ratio shows that it has spent most of its history trading above its book value. But as I record this, STWD is priced at 5% below book value, implying a low price. The other way I look at price is the historical yield. This chart from Snowball shows the yield history for STWD. Apart from that huge spike during the 2020 pandemic, the yield has remained mostly below 10%. Current yield of 10.19% also implies a more attractive price. I use Snowball to keep track of all my dividend income in one place, and it gives me more information than my brokers do, things like ranking by yield, income growth, performance, etc. I'll put a link in the description for a free trial and a discount. It's quite affordable. I think some Starwood investors read news stories about SREIT and confused it with STWD, mostly because the name Starwood's in both. And they thought that they were somehow connected, so they just sold their STWD. Also, the media spun the story as a fund in distress or a bank run, and it's really more of a short-term liquidity issue. If the demand for redemptions is unusually high when property values are unusually low, this can happen to a private REIT, as I mentioned before with the Blackstone example. A more balanced version of the SREIT story was published by CoStar. They're a trusted source within the commercial real estate profession, and I'll include a link to their coverage of this in the description. The irony is that SREIT is short on liquidity and STWD has a ton of liquidity. I'm not saying that the STWD price has bottomed or that it's going to bounce back next week. As an income investor, I'm more focused on the income than the price. Typically, STWD yields less than 10%, and currently it's yielding more than 10%, despite no deterioration in their business and no new risk. That makes it more attractive than it was, say, a month ago. I already owned some STWD, so I simply increased my allocation. It was previously about 2%, and when the next edition of Armchair Insider comes out this week, you'll see that it's more like 3% of my portfolio now. If you'd like a copy of my portfolio with regular updates, there's a link in the description. It's free. There's still concentration risk with this one. It's just one company, and any company can run into problems. I generally allocate more to funds than to individual companies to spread out the risk. STWD isn't a match for every income investor, but if you're comfortable with mortgage REITs, they are a little more risky, then it's worth knowing why this particular one dipped in price recently. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you time. That wraps it up for this Starwood update. More armchair income coming soon.